Hello, fools. So it's just past 2 o'clock on the East Coast, and I want to welcome everyone to the Millionacres Hour, where we get to talk about my favorite subject, real estate. So today we have Jason Hall, your usual host of The Wrap, here with us for this hour, and we're going to interview Jilliene Helman of Realty Mogul. So I've been following her career for a while. She's a leader in real estate crowdfunding, and she is the chief executive officer of Realty Mogul. So she's been involved with investments of property values over 2 billion, including over 15,000 apartment units. She's really a pioneer in real estate crowdfunding. So welcome, Jilliene.
Thanks for having me on today.
Excellent. Jason, do you want to kick us off with the first question?
Yeah, Jilliene, welcome. I'm really excited to have you on. I have to say, I've followed this space for a few years and done some deep dive reviews of a lot of the platforms, and Realty Mogul consistently comes to the top of the list for me as one of my favorite platforms. Just a couple things. It's one of the highest scoring that I've reviewed. In particular, this mix of high quality standalone offerings that accredited investors have access to, but also REITs. You have a couple of really high quality REITs that non-accredited investors can get to. That's important for us at the Motley Fool, is increasing investor access, right? So what I would like to give you an opportunity to do is just share a little bit about Realty Mogul and what you think sets Realty Mogul apart from your competitors in a really crowded space.
Yeah, absolutely. First and foremost, thanks for having me, to both of you, and also Jason for the introduction and the reviews on our business. You know, I love how you lead with mission for Motley Fool, which is all about getting investors access to different investments, obviously at Motley Fool, but at Realty Mogul, we're exclusively working on commercial real estate transactions, and that's been our mission from the beginning. You know, give individual investors access to high quality commercial real estate transactions, and do it in a way that's very accessible and very easy, right? And so we have a digital delivery through our crowdfunding platform. And as you mentioned, we have the ability for accredited investors to invest on a deal by deal basis. And we also have the ability for non-accredited investors to invest in one of our two real estate investment trusts. One of those REITs is really focused on income generation. The other REIT is really focused on growth. And, you know, I think that there's some amazing players out there. You know, our competitive set is an amazing competitive set. I have nothing negative to say about them. I think that we've all built this industry on our backs over the last 8 years. I think that the main difference probably between our business and some of our competitive set is we tend to focus more on straight down the fairway deals. And that's a good thing for investors and a bad thing for investors, right? So I'll just share it openly and transparently. A lot of transactions that our competitors will do, we will have passed on. There's a deal that went up on another platform just yesterday, and there was an email circulating our company around, you know, we passed on this 2.5 weeks ago. And, you know, do we stand by the decision to pass there despite, you know, it being really well funded through a competitor? And we did, because we didn't believe in the fundamentals. That happened to be an office transaction in a market that we don't want to go long in office. So that's why we declined it. It wasn't, you know, sponsorship or anything of that nature, but we tend to be more conservative. You know, one of my favorite people to read in this industry is Howard Marks at Oaktree. And he talks about, if you want to be in the top 5% of fund managers or investors, you have to be willing to be in the bottom 5%, right? Because you have to do things that are so different than your competitive set. And we're unwilling to do that. So we tend to stick pretty right down the fairway. You know, 70% of our business has been multifamily. We've made office investments, some retail investments. We do no hospitality, which, you know, helped a lot during the pandemic. Obviously, no one could have imagined what was going to happen in hospitality, but we've really tried to stick pretty much down the fairway, with this thesis that you can get really great risk-adjusted returns in real estate without taking a lot of undue risk. And so we've tried to minimize risk on our transactions. We're really proud of the track record, but what it means is we don't do as many transactions, right? There's other platforms that are doing more deals than we are. And we've made a decision that we're okay with that, right? And we're in this for the long haul. And so that's a big kind of differentiator between us and other platforms. But I think the industry as a whole is really doing a great service to individual investors in particular.
Oh, just a follow-up question on that. And then Deidre's got a number of really good questions we're going to go through here. But one of the things that I found reviewing these platforms, and I've looked at probably 24 different platforms, and there's 50 more out there that we could look at, and 100 past that we would never even consider looking at. But one of the first things I learned is to kind of follow the money. And what I mean by that is, for every platform out there, there's a little bit of a different way to monetize it, right? Whether you're charging the sponsors for a placement, to put it on to list it in your on your on your website, or whether you're taking a percentage of the investor's contribution as a pass through, whether you're charging the investors directly, asset management fees, some mix of that. Then you have, all of the different promote structures and that sort. So there's all these various ways to make money. And one of the things that I've found, and I just would like to hear your thoughts on it, before we kind of get more into kind of some of the nuts and the bolts of the market right now, is because this gets to your point about passing on deals. Is my experience is that a lot of the platforms that have a lot of deal flow, if you follow the way they make money, they tend to prioritize deal flow, because that's where they get their money, is on the deal flow and not necessarily in a share of the returns on the deal. Right. So I'm curious, like, your thoughts on the tension between monetizing the platform and also prioritizing the due diligence to make sure that you're offering high quality investments and being willing to walk away from a deal that you could make money on because you don't think it's right for your investors.
Yeah, look, at the end of the day, it comes down to culture, right? For us. And we talk a lot about culture. And our number one cultural value is sleep well at night. Our number two cultural value is protect the investor. Our number three cultural value is own it, right? So live by our decisions, sleep well at night, and protect the investor. We're, I think, rare in sort of the crowdfunding industry in that we are a profitable business. So we don't have to, go look for where's our next dollar coming from. There was a number of companies, unfortunately, during COVID that had to do mass layoffs. That was not us, right? And so it's been really important to us to be financially disciplined. Once we got the platform up and built, obviously we had a huge investment in the technology. We had huge investments in marketing, but since we solidified ourselves as, I think, one of the top, three players in this industry, it's not a winner take all business, right? So we're not willing to spend capital, and we're not going to have a healthy return on that capital. And that's the same way we think about real estate investing, right? We don't want to do deals that we don't think make sense. And so our culture, I think, keeps us really in check for not doing deals that we shouldn't be doing. I sit on investment committee, our CIO sits on investment committee, our head of asset management sits on investment committee, and we have a lot of debates around deals. And the reality is, we thought we were going to go into a recession much earlier. We've been playing defense since 2015. And the reality is we were totally wrong, right? We could have made tons more money if we were more aggressive the last 5 years, but we didn't feel comfortable there. None of us could have predicted, obviously, what happened with the pandemic, but for us, it comes down to culture. And I think you're right around incentives. We have made it a priority to have a piece of the deal on the back end from our sponsor partners. And so we're very much invested in the back end of these transactions. And I think it also leads into us being very long-term focused, right? We could have charged, very expensive upfront fees, and that would make us not very back-end focused, right? We're very back-end focused. I look at this business and I'm thinking about, what does it look like 10 years out? What does it look like 20 years out? What does it look like when we've deployed, and do another $10 billion of real estate transactions? How much wealth can we generate for our investors? So it's a longevity mindset. And I really think that it's culture. And I came from a very, very conservative Japanese bank. I worked for Bank of Tokyo Mitsubishi, which is sort of the Bank of America in Japan and their US subsidiaries. And I went through the '08 crisis with that bank, and we had almost no losses in the commercial real estate book. It was a very, very conservative training. And so I am for sure an entrepreneur. I love running companies. I love managing teams. But at the end of the day, my roots are a conservative banker, and you can't shake your roots.
Excellent. So you mentioned earlier 70% multifamily deals. So how has multifamily served you during this crisis, and what are you seeing in multifamily right now?
Yeah, look, incredibly grateful to be concentrated in multifamily. Hospitality is really suffering right now. Senior living is really suffering right now. Student housing is suffering right now. Retail was suffering pre-crisis, but continues to suffer. Our office transactions have actually fared very well, and we can, talk a bit about office maybe later in the conversation. But really grateful to have our concentration in multifamily. We've invested in over 15,000 apartment units. And, the reality is that unprecedented federal stimulus has done a lot of good for the multifamily markets. You've had government intervention, which has distorted the markets and really helped us to avoid a crisis, which puts us in a very different position today than we were in 2008. The increased unemployment benefits, the direct stimulus to, citizens, and now most recently, the announcement for $25 billion for states to allocate back rent to keep people in their homes when the CDC eviction moratorium ends in January 2021. That was the latest news out of Congress, just 24 hours ago. So I think that it's really held up multifamily, right? And although transaction volume is down year over year, which is largely due to the great pause in Q2, I think our firm and most other firms in the market in Q2 said we're going to push the brakes and we're going to watch and see what happens and make sure that if we're going to be investing in transactions, it makes sense to be investing in those transactions. But although transaction volume is down, pricing is holding. We are very active in the markets across the country. And there were two deals that we did. It was a 2-property portfolio in Dallas. And I think those are going to be the only 2 multifamily deals that truly have a COVID discount. They were able to negotiate a COVID discount because there was so much uncertainty. This was in, March of 2020. But I don't know that we're going to see other COVID discounts, especially in multifamily. I think you'll still see them in, hospitality, if you want to call them, in retail. I think there's still some stuff coming in office. But in multifamily, it's holding up incredibly well. The big question is what markets? Different markets are behaving differently. And I view the 2008 recession as a truly national recession. I view the COVID recession as sort of a micro market recession or a very local recession. You're seeing different markets have unemployment rates play out very differently. Different markets have, rent growth or rent degradation play out very differently. So the local markets are very different. But as a whole, multifamily is holding up the best of any asset class. And you're seeing more and more capital rush in because folks are looking for that safe haven that I think you can find in multifamily compared to the other asset classes.
I'd be interested to see, just to follow up to that, your expectations going forward for multifamily, say over the next 5 to 10 years. We looking on the home buying side, obviously there's massive pent up demand. The question is how much of that demand is going to be able to be met by home builders. There's certainly no inventory of existing properties. So I'm curious of your thoughts in terms of how that could potentially play out for multifamily, since that's right in the core of your business.
Yeah, absolutely. I mean, I think we still have a dearth of supply of particularly affordable multifamily in the US. It's challenging to build affordable multifamily. The numbers just don't work. The math doesn't work. You can build Class A multifamily and those economics work. But I think that this recession is very different than the '08 recession in that we don't have a supply and demand imbalance, right? We had too much supply in '08 on both the single family side and on the apartment side. We don't have enough supply today. So I think that plays out. That being said, there's a lot of developments, right? I think folks thought that the construction starts were going to diminish pretty substantially when COVID started. And the reality that not all, but a lot of them have gotten back on track. So I think you're still going to see a lot of deliveries in 2022. I think you're still going to see a lot of deliveries in 2023. But I think that you're going to see household creation start up again, right? In recessions, it contracts. People get roommates, people move back in with their parents, whatever it may be. I think that we'll go back into a time of, positive economic growth, which is typically good for household creation. So I think multifamily is going to do very, very well over the next 5 to 10 years. I tell our team, I don't want to make any investment in a multifamily transaction that we're not comfortable owning for 10 years, right? And that doesn't mean that that's the business plan, but it means that we have to have that level of comfort. What I think is going to happen in multifamily is returns are going to come down. Right. I think that COVID has made people realize that on a risk adjusted basis, it is so much less risky comparatively than some of the other asset classes that returns are going to come down. And, real estate and particularly multifamily investing, it's no longer an alternative investment class. You have tremendous amounts of capital being deployed, a lot of institutional capital, a lot of retail capital. So I think multifamily is going to do well. The one potential concern I have around our ability to continue to acquire and invest in multifamily is if cap rates continue to come down because of the cap rate compression, because there's so much demand from investors from multifamily and interest rates move up, right? And what's going to happen there is returns are going to come down and eventually interest rates will come back up. I mean, I don't think that it's going to be anytime soon, but eventually they will. But that's going to compress the returns for multifamily. When we first started this business in 2012, we wouldn't really touch a multifamily and deal unless we were underwriting a 17, 18, 19% kind of return on a value add multifamily deal.
Right.
Then it was a 15, right? So the last couple of years, it's been kind of a 15. And now it's sort of a 14, and I think those numbers are going to keep coming down. That being said, I don't personally know where I can deploy capital at the same risk adjusted return level and earn even a 12, let alone a 14 or a 15, which is where we're underwriting most of the existing multifamily today. Development's a different story and a different risk.
Idra?
So you mentioned Dallas earlier. Are there any markets that you're staying away from? I know rents have fallen in San Francisco, in New York to some extent. Are you worried about those places, or do you feel like they're going to come back strong?
So my belief, and this is more philosophy than data, but my belief is that as humans, we have relatively short memories. I hate to bring up 9/11, but you look at 9/11 and everyone said no one's ever going back to the city, right? No one's going to live in New York. No one's going to go to work in these skyscrapers. And lo and behold, a couple months later, life felt relatively back to normal, for those kinds of folks. Obviously never back to normal for those who lost people in that tragedy. But I think that you will see life return back to normal. It's a matter of how quickly, right? We do not like New York City at all. Nobody likes New York City right now. As much as I dislike it from COVID, I probably dislike it more because of the political arena and rent control and, how challenging it is right now to invest in the housing stock there. But I have to tell you, I think that by 2023, New York is going to be back, right? And so there's probably going to be some really fantastic buying opportunities in New York late 2022. So I could see us, getting very aggressive and wanting to invest in New York in late 2022. It's not today and it's not next year. San Francisco is a similar story, right? I think that rents have come down in San Francisco. I think that with all the companies that are determining that they're going to have remote work, forever. So not the Googles of the world, but the Twitters and the Facebooks and some of these other major companies that were, a huge part of the market, the residential and the office market in San Francisco. That market's going to get hammered, but by 2023, it'll probably be back, right? So, I don't like Orange County. I don't like New York. I don't like Las Vegas. On the flip side, there's a lot of markets that I think are going to be, recovering much faster, right? I expect Phoenix will recover really fast. I expect, Jacksonville, Indianapolis, Dallas, those are going to, recover really quickly or didn't really take a huge dip. We track a number of markets where there actually has been rent growth. And that kind of goes back to it being a micro market recession versus a national recession.
So to me, that sounds like kind of your core focus remains, even though there could be some opportunities in terms of maybe buying properties at a lower cost, in the interim, you're still prioritizing the predictability of rents and understanding when the market has recovered in terms of generating cash flows before you get aggressive on any deals in those markets, before you see some signs of what they're going to look like. Is that kind of how you're thinking about it?
Yes and no, because there's always nuance in real estate, right? Yeah. And one of the things I love about real estate compared to the public markets, and maybe this is going to sound crass, but it's not intended to, so I'll caveat myself, is you can trade on insider information legally in real estate, right? You can't do that legally in the public markets, but in real estate, it's a private market, and that's what it's all about, right? So if we are looking to buy an asset, I would do a deal in any market in the country today at the right price, right? It's all about basis. It's all about business plan. It's all about the people, and knowing that you can execute on that business plan. So there's a world where we would buy a deal in New York today, but I wouldn't say that I'm going to go buy aggressively in New York today, right? So there's kind of that nuance and that caveat on when we expect those markets to come back. I mean, I'll share with you the last series of deals that we've done in the midst of COVID. We did 2 deals in Dallas. We just closed a deal in Phoenix. We just closed a deal in Columbus. We're working on 2 deals in DC, right? And the DC market's gotten hit, relatively. It's a major city, but there's 2 deals there that we think are, really interesting. So, we're looking in every market. It just matters where we think that we can buy something that makes sense. And if you're buying in a market like New York or San Francisco, we have to underwrite pretty significant negative rent growth, right? Until at least 2023. And so most deals are not going to work, but that's not to say that you can't find a deal that is going to work even with those, I would say realistic, not conservative underwriting assumptions.
Makes sense. One thing I want to mention real quick too, to all of our live participants, just a reminder for Slido. So we're hoping we have a few minutes near the end to do some Q&A with Jilliene. So just a reminder for everybody how to do that. Go to Slido in your web browser, sli.do, and the event code MFLive, all one word, MFLive. And if time permits, hopefully we can do a little bit of Q&A with your questions as well. Deidre.
So you're wondering about these markets and if you have the same ideas about office in these markets that you do about multifamily, and where are you looking for opportunities in office right now?
Yeah, I mean, office for me right now is all about cash flows, right? If you have long-term leases lined up with companies that have the financial wherewithal to maintain those, I'll give you an example of an office deal that we did, which people may have said, you were crazy to do this in the middle of a pandemic, but we closed a deal, an office transaction in Las Vegas, Nevada, shortly after COVID hit, right? And on the surface, I would also call you crazy, right? And I would say that's never a deal that we're going to do.
Nuance,
and Las
right?
Vegas is not a market that we're focused on, right?
Yep.
As I think I mentioned that one as, a non-darling earlier in the conversation. So why did we do that deal? Well, it's a credit tenant. The tenant is NV Energy, which is a subsidiary of Berkshire Hathaway.
Right.
There was an extended lease on that transaction, and it effectively was a covered leasing play, right? Where the tenant had no option to get out of that lease. I think we have 9 years to backfill if the tenant were to leave that lease. And so am I willing to bet long that Las Vegas is back in action in 9 years? 100%. I'll take that bet all day long. Right. So it all comes down to tenancy in office, and that's tied to location, obviously. We're very weary of underwriting any rent growth in office, any appreciation in office. I mean, I think it could take a very long time for appreciation to come back in office. I do think people will go back to offices in some way, shape, or form. Again, I think we have short memories. I was talking to a gentleman that I know in China, and he was saying everyone's back in the office, right? Everyone's back in the office. It's sort of as if COVID never happened. And things are continuing, and not saying that the U.S. is going to behave the exact same way. There's obviously, nuance to culture and otherwise, but, we're really looking at credit tenancy. We're looking at also, opportunities. There's an office deal we're looking at, which is a conversion of multifamily, right? So they're saying office is no longer the highest and best use for this asset. We want to do a pretty significant renovation and convert that to multifamily. That's kind of interesting to us. But it all comes down to tenancy. We're not doing any spec office. In fact, the deal that I mentioned earlier that we turned down was a spec office deal. And we just said, it's not the right time. We don't think to be investing in spec office. If we can invest in something and generate a really great cash yield, because there's a difference between the cap rate that we're acquiring the office and where interest rates are today, we'll take that cash flow play. And that's what the Las Vegas deal was. NV Energy, it was a cash flow play. And we didn't underwrite any of the upside, any of the appreciation, which if it happens, great. And if it doesn't happen, we've got high quality tenancy. So, I think New York office is very scary. LA office is very scary. San Francisco office is very scary. Dallas is probably one exception. Austin, maybe, right? I mean, you've just got so many companies that have announced that they're moving into Texas, right? With Oracle and CBRE and Tesla, right? So those are markets where I'd look more closely and I'd be willing to take more risk. But I think office comes back. I just think it takes a while.
It's tough to know, right? For every Jack Dorsey that's saying, we want to try to make remote as possible for everybody as we can, you have somebody like Reed Hastings that says, I want every single employee back in the office. So it's so hard to project, right? So I think that's kind of the big point right there is we don't know exactly what the future is going to look like, but I do tend to agree with you. It's probably going to look more like it did in the past than it looks right now. It's going to be somewhere in the middle.
I think it's going to be flexible office.
Yeah.
We think a lot about talent, right? I mean, the single greatest asset to my business is our people, right? And we're only as good as the collection of people at the company. And so I don't think that you're going to be able as a CEO or the head of a company to be able to recruit the highest quality talent by mandating that people are in an office 5 days a week. I don't think people want that lifestyle, and whether it's irrespective of age, like we've all now experienced over a year, right? It'll probably be 18 months by the time that folks are back in offices. Life feels different, right? And I think for a lot of people, it feels a little bit better. It's more time with your kids, the ability to eat healthier, the ability to exercise, picking up an hour, even if your commute was 20 minutes, that's still an hour by the time you park your car and, do all the things to go into an office. So I think that the war for talent is going to be won by having remote flexibility. And so I think that that's going to really challenge office. That being said, I think companies will still have a physical presence, right? I think about Realty Mogul. We're going to have a physical presence again, right? Because we have clients who want to come in and want to meet us and, want to know that there's a fancy building somewhere where we're talking about investing their capital, right? But there's no way I'm going to mandate that 100% of my team is in the office 100% of the time, because I won't be able to retain and recruit the best talent. So I think it'll be somewhere in the middle.
Yeah.
But who knows? All speculation at this point.
Deidre.
I wanted to ask you about real estate crowdfunding in general. This year we saw the SEC change some of the rules. Do you think that we're going to see more investor access? Do you think that we're going to see some of the loosening of regulations around accreditation in the coming years?
I certainly hope so, because as much as we, try and create great products for non-accredited investors, there's so much more access for accredited investors, right? Not only in real estate, but in other asset classes. Just to allude to kind of what you were talking about, the SEC came out and said that certain professional certifications would now allow an investor to be deemed an accredited investor, even if they don't have the net worth or liquidity requirements. And they started with Series 7, Series 63, Series 82. So, professional financial licenses. I was shocked at that point in time that they didn't also include the CPA and the JD, right? So open it up to all attorneys, open it up to all CPAs. But if you read the nuance in the legislation, they made it very clear that that would be added in the future, I think, right? Again, Jilliene speculating. So I know it's not called the Jilliene Speculation Hour, but I'll make it the Jilliene Speculation Hour. So I think that they left the door open for that in a very clear way that wouldn't require a lot of back and forth. And so we're really excited about that. I think that, ideally they'll open it up to people who have an MBA. Ideally, they'll open it up to JDs and CPAs. So I do expect that to happen. But it takes time. This is one of the first changes to the accreditation definitions in decades upon decades. So I think this is their way of testing the waters and making sure that everything's okay, with the rollout of a broader scope of individuals who can qualify as accrediteds in the future.
So with that in mind, why would investors, as it's becoming more open, why should retail investors consider crowdfunded real estate versus just buying, a publicly traded REIT?
Yeah, look, I think that there's a lot of arbitrage in the private markets, right? As I mentioned earlier, in the private markets, you can legally trade on insider information. I am a big believer in the middle market real estate space, and that's really defined in my book as deals under $50 million. So if you look at, the over 100 transactions we funded at Realty Mogul, majority, if not all of those, are under $50 million. And there's less competition there, right? There's more opportunity to use insider information. There's more opportunity to win deals because of relationships. There's less, outwardly brokered transaction. There's more opportunity to be really creative about the execution. Most publicly traded REITs are not trafficking in that space, right? They're buying the bigger deals. They've got billions and billions and billions of dollars to put out. And so they have to work on bigger transactions. It's similar to a lot of private equity firms won't write a check, less than $20 million. And so it kind of leaves this middle market world really open. And if you look at the data, the middle market real estate transactions tend to outperform the larger transactions. There's, exceptions on both sides of that fence, certainly. But I think that that's one of the main reasons is it's a way for investors to get into middle market real estate. It's also a way for investors, I think, to get really educated. If you buy shares in a public REIT, you're probably not going to read the 10Ks and the 10Qs, right? I do, because I'm just, nerdy like that. And I learn a lot and I enjoy it. And, I run 2 REITs, so I should be educated. But we have found so many investors say to us, I invested $25,000 in 3 or 4 deals with you, and I've learned so much, right? Because we do reporting on a granular property level basis. So here's what's going on at the property. Here's what the rent bumps are. Here's what the vacancy is. Here's what the return on cost is. Like there's hundreds of people who have used investing with us as their real estate education to then go on and buy their own deals, right? Which is fantastic. We're big believers in having exposure to real estate. So I also think that it's a lot more fun to be able to see the specific assets that you're investing in rather than investing in a blind pool, which a lot of these public REITs are, unless you actually go read, the disclaimers and the financials. We are very transparent in both of our REITs, in addition to the individual assets. What are the specific properties you're buying, right? What are the addresses? If you want to go, step foot on those properties, and we'll have investors send us photographs of properties that we own and say, hey, I was driving by and, I took a bunch of photographs and here's me in front of it. And, I'm an owner. And so it's definitely kind of this coolness factor about it. But I also think there's a real legitimate financial reason, which is middle market tends to outperform, the expensive, more competitive stuff, and remains to be seen if it continue well too. But, we like the middle market space a lot as a result of that.
I want to give you a little hat tip here. It's not just that you guys provide that information, but you make it readable and easily consumable for regular Joes and Josephines out there. So I want to give you some props for that. I think you guys and Cadre and Streetwise, the little shop just down the street from you guys, I think the three of you do the best at getting the information to people in a way that's easily consumable. So
thanks, appreciate it.
Yep.
So on the other side, I was wondering, are you seeing more sponsors being interested in crowdfunding? I think that's one of the things that's been interesting, is that sponsors used to be a little more sort of hesitant. So are you seeing more developers coming to you with deals than you used to?
Absolutely. In the early days, we were having to sell ourselves, right? And say, this is who we are and this is what we do. And, it's the typical adoption curve for technology, right? In the early days, you get a bunch of early adopters and you think you're onto something and it's amazing. And then you go through this sort of this lull where, you're not so big that everyone knows you, but you're not so small that you don't have any business. We're on the other end of that curve now, right? And I credit us, and I also credit our competitive set, who have done a great job of educating sponsors. It is very mainstream now to finance your transaction through crowdfunding, right? And we have sponsors now pitching us, as opposed to us pitching them and selling to them. They're coming to us and saying, hey, we want to build a long-term relationship with Realty Mogul. I mean, we know the benefits of this, because the skill set of raising capital is a totally different skill set than acquiring and operating real estate, right? And our philosophy has always been, they're different skill sets, and we would rather that we have sponsors that are great at acquiring assets and managing assets than raising capital, right? Because that raising capital skill set doesn't help us in the financial performance of the transaction. And so I would say that there's much more widespread adoption today. We frankly have more business than we know what to do with, right? And that just means that we decline a lot of transactions. We're very focused on sponsor experience. So there's sponsors that want access that we decline because of experience. And then there's a lot of sponsors that are incredibly experienced. I mean, we have sponsors that have done $2-3 billion in transaction volume, and they're now turning to crowdfunding, which I think is indicative of it really becoming a mainstream industry today.
That actually brings up talking about prioritizing experience and developer and the sponsors that you work with. One of the questions I wanted to ask is, in the crowdfunding space as a whole, there's a combination of really smart tech people and really smart real estate people, and a little bit of some that are kind of a mix. But I'm just really curious to hear, in terms of how you think about your talent base and prioritizing great real estate people versus great tech people to get the platform and the technology as good as possible.
Yeah, so I'd answer with one word. We're a fintech company, which means we're both, but financial services leads, right? Because you can't build this business if you do, in my opinion, if you don't have financial services first, because people are investing real money in real investments, right? So no matter how slick your technology is, no matter how cool your distributions are, it doesn't matter if you're investing in transactions that don't perform. And they're, in the early days of this business, kind of back to 2012, 2013, there were a bunch of CEOs that popped up that were very much technologists and technology people. And most of those companies did not make it, right? Because they weren't focused on long-term thinking around the investable assets. Mm-hmm. So, we have both. We have an amazing technology team. It's not to knock them at all. They're fantastic. Our VP of engineering has been with me, nearly 5 years, and he's just done a great job in building out the tech on our platform, and his team. But at the end of the day, we're a financial services company first. And I believe that we have, it goes back to our value set, right? Our value set is sleep well at night and investor protection, right? And those things really lead us to being a business where we care so much about each and every single one of our investments that that's the top priority.
I think that's a very good answer. I'm happy with. Deidre, go ahead.
Putting me on the spot there, Jason. Appreciate that.
Earlier, you mentioned that you're not doing hospitality at all. It seems like there's going to be some distressed assets in 2021. There might be some opportunities there. Is that an area you're considering at all, depending on what happens, or is it probably going to be a hard no for you?
It's such a hard one. We stopped investing in hospitality in 2015 because it's really, from my perspective, an operating business, not a real estate business.
Mm-hmm.
And so we had to go kind of in the core of our heart of hearts and say, are we a platform that invests in operating companies today, aka hospitality, or are we a platform that, really, really wants to stay kind of tried and true real estate? There's one hospitality idea there's two, but one that's truly hospitality. One is hospitality to multifamily conversions, and we're multifamily people. So that's an easy one for us. And we're looking at a couple of those. But the other is transitioning existing hospitality into long stay hospitality. So instead of doing, one night, someone comes and rents a room, the minimum is, 30 days or 60 days or 90 days. That feels more like hospitality. So it's a little bit less of a hospitality business. And that's something that, we've been toying with, and we've been having conversations with a very, very, very great, deeply sophisticated sponsor. So we may be able to get our arms around that. But probably not, to be totally honest. I mean, it's still an operating business. I think more, one of the great lessons from COVID is that it was an operating business, right? And I don't know that investors who think that they're investing in real estate and are thinking about their real estate allocation should have an allocation to hospitality. Now, if they're thinking about their overall investment allocation and they want to have some allocation to operating businesses in addition to real estate, I'm not opposed to it, right? As kind of a full-fledged portfolio. But in general, unless I was running the hotel, I don't know that I'm going to be investing in hospitality.
Do you ever really want to run a hotel, Jilliene? Let's be honest.
No. You never know, right? Never say never, but I'd finance it myself because I don't think that I'd want investors coming into that operating business either. But no, look, I think that a lot of the boutiques hotels have done fantastic during COVID, right? If you have some kind of shtick, you have some kind of niche, those hotels I think are really interesting and really fun. But I don't see us going long hospitality right now. Although I do think it'll come back. Mm-hmm. So I know you didn't ask me that question, but I do think it'll come back, and I do think business travel will come back. And someone asked me recently, business people are never going to travel. Are you ever going to travel the way that, you once traveled? And the reality is salespeople are going to get on the plane, right? Salespeople are going to get on a plane and they're going to sit face to face with people and they're going to do a deal. And as soon as that starts up again, you're going to have to get on a plane and go face to face again to win business, right? And so I think that a lot of that hospitality travel or business travel rather will come back, which really fuels a lot of the hospitality business.
I have a thesis I want to bounce off of you and see your professional opinion on. I think about, we talk about this transition of work to home and a hybrid and whatever work and living looks like, say 2 or 3 years from now. My thesis is that the convention business is either going to fully recover or be even bigger, right? And I think there's a case for it to be even bigger if hybrid and work from home becomes a bigger part of the way people work, because companies are going to prioritize finding ways to get their people together more. So I think some of the real estate companies that I'm really interested in are really big in the convention space, and I think there's some opportunities there. I'm just curious as to if your thoughts on that.
I think it's a good thesis. People are social creatures, right?
Yeah,
we like to be together. We like to congregate. And I think you're right. I think more companies are going to be remote. I mean, I could see, NMHC is like the biggest conference of the year for our business, right? And it's coming up in January, although, we'll be remote. And I could see, if I don't have all my employees in the office, we'd send, historically we'd send 5 people and now we'd send 10 people and do a big event and, get in front of people and make it a social outing. So I totally agree. I think you're spot on. I think next year is going to be hard.
Yeah.
Right. I think that a lot of people are going to get the vaccine, by the end of next year, and people are going to be comfortable. But I think it'll really start to come back in 2022 and 23. I think the next 2 years in the events business is still going to be pretty tough.
Yeah, I agree. I think there's the expectations are probably starting to get ahead of the reality at this point.
Yeah.
Deidre.
I want to make sure we take a look at some of the questions we've got
Good
coming
idea.
in, and one of them is liquidity a concern with private crowdfunded REITs, and is there a minimum holding period for your REITs?
Yeah, so the REITs act a little bit differently than the individual assets. And on the REIT perspective, we don't have any concerns around liquidity. I mean, we entered the pandemic very, very liquid. We have minimum liquidity requirements that we feel really comfortable with. So I would say that the liquidity question is as good as the management team, right? You really want to look to the management team to make sure that they're making the right decisions around REITs. In our REITs, we have a 1-year lockup. So if you invest, you can't get out for the first year. And then thereafter, we have a penalty for the first 3 years. So if you get out in the second year, it's a 2% penalty. If you get out in the third year, it's a 1% penalty. The reality is we really don't want people investing for the short term in our REITs, right? So if you're thinking about how do I get out, what's the exit, it's probably not the right vehicle for you, right? Which is strange for me to convince you not to invest with us, but I just try and be open and honest with any investor so they can find the right vehicle. So we really want long-term investors. We don't want dinner table money. We want folks who really believe in real estate for the long term and are looking to make a 5 to 10-year investment and use it as a diversification mechanism for themselves.
Something I just dropped in the chat here in Zoom, I encourage folks to look at is the review that we did of the Realty Mogul platform, and it does have some information about the structure of the REITs and the ability to win, the liquidity options and that sort of thing. It also has some more information that's important too for the standalone deals because each deal is different, right, Jilliene, in terms of how long the plan is, what your minimum investment might be, return profiles, all of those things.
Yeah, on our individual deals, the hold periods range from 2 years to 10 years, so there's a lot of variety depending on sort of what you're looking for and what you think is the right investment opportunity. I would say though, in general in real estate, hold for the long term, right? I don't love day traders in real estate, right? And there were some big opportunities in the REIT world through COVID, don't get me wrong, and some people made a lot of money, but I invest in real estate the same way I invest in the public stock market, which is invest in companies that you want to own long term and invest in properties that you want to own long term, right? And your likelihood of getting hurt, I think, is a lot less when you invest with that philosophy and that theory.
I want to ask your comments on this. I'm going to read the question here first. Always Learning Fools asking how to invest in the Mogul REITs. I can just hit the top part of that. They're not available on any exchange. You're directly giving your money to Realty Mogul through their platform. You can go to Realty Mogul's website and create an account. To do that, minimum investment, Jillian, still $5,000 for
Correct.
your REITs. Can you please lower it? Thank you. I'd appreciate that. You never hear that. But here's what I wanted to say, and I wanted your thoughts on it. The reason those limits are, the amounts are the way they are, and the reason there's liquidity restrictions is, again, this isn't a secondary market. You're giving the money to Realty Mogul. Realty Mogul is taking that money and then allocating it. They're investing it in debt. They're investing it in properties. And if you want to sell it, you're going back to Realty Mogul and saying, hey, I want my money back, right? So to Jillian's point, talk about that tension again between your goal of finding good long-term opportunities and giving investors access to that liquidity.
I think it starts with just total and utter transparency up front, right? I'm sure you've had well, maybe not because you guys are good at vetting, but I'm sure there are other CEOs who would come on here and say, invest with us and there'll be liquidity when you need it, right? And that's not the message I'm saying.
Right.
It's very much like these are long-term investments, and you're totally right, Jason. There's a mismatch between what we're investing in and if people want liquidity in a year, right? We don't want to ever be in a position where we have to go sell an asset. We keep liquid capital in the REITs, as a matter of policy, right? And I think an ample amount of liquid capital in the REITs is a matter of policy. But the reality is we're long-term thinkers, right? And so it's important to us to be culturally aligned with our investor base. That being said, there's things that happen, right? I mean, we've had people who have come to us and said, hey, I realized this was a long-term investment. I lost my job because of COVID, so I want to be redeemed because of that, right? I mean, we try and do as best that we can by investors and manage that. And that's why we maintain, minimum liquidity standards in the REITs at all times. But that's not the norm, right? We're really trying to educate investors to say, if you want to invest with us, plan to do it for the long term. It takes a long time to build value in real estate if you don't want to do it with an immense amount of risk, right? You can build value in real estate very quickly if you want to take a lot of risk, right? You do a big redevelopment, you do a big construction project, you do spec industrial. I mean, there's ways to move very quickly and create a lot of wealth in 1 to 2 years. But that's not our strategy in the REITs, right? Our strategy in the REITs is to be steady, to think long term, and to have income growth and appreciation growth on a year over year basis, but not to take undue risk. And so in that vehicle, we're really looking for investors who want to invest for the long term.
One question we're getting a lot is, does Realty Mogul invest anywhere outside the U.S.?
We do not. We're just domestic today. We've looked at a couple of things in Puerto Rico, which you could call out of the U.S. or not. But the biggest concern I have is local regulations and local laws, right? So I've heard kind of horror stories in certain countries around title and not truly having title to your assets. I think there could be a world in the future where we do. I think that if we did that, we'd start in Canada. I'm a Canadian citizen, so that would sort of make the most logical sense. But if we were going to do it, we do it with partners that are, tried and true on the ground there. Because I think that actually going back to an earlier question that Jason asked, how are we different than our peer set? I think one of the big differences is we step foot on every single property. So, one of the peer sets in our business doesn't believe that, they have to step foot on every property because they're trusting in their partners, and they work with some phenomenal partners. So don't get me wrong. I'm not knocking those partners, but I just don't believe that we can do full due diligence on a transaction without stepping foot, right? And without someone being on the ground, even during COVID, right? And during COVID, I've said to my team, you don't have to travel, but if you don't want to go, I'm going to go personally. So we did a deal in Columbus, Ohio. I popped in a plane and I went out there. We're, doing another deal in Lake Orion. I popped on a plane and went out there. The 2 Dallas deals I had seen, so we feel strongly that you need to step foot on the assets. And so if we were going to build something internationally, it would have to be in partnership with someone who we trusted to step foot on every asset and trusted their analysis of those markets and those assets themselves.
So Husky86 is asking a good question that I think is important. One of the things when we look at businesses of all types is we like to see skin in the game, right? Whether it's having a personal stake in the business itself, and particularly in crowdfunded real estate, having exposure to the actual properties that are going through your platform. And I'm curious to hear just your thoughts on that. The stakes that you take in the deals that are offered, the standalone, your financial stake in the REITs, and just kind of your thoughts on how you think about skin in the game at a deal level.
Yeah, absolutely. So on the REIT front, the parent company is an investor in both REITs. But I think more importantly than that, frankly, is a lot of our compensation on the individual deals is back-ended, right? So we're compensated. We take a piece of the operator, a piece of the sponsor's promote. So we're going to get a significant piece of our compensation on the back end if the deal performs. If it doesn't perform, we're not going to be compensated, right? And there's this inherent conflict, I think, between building a business and investing every single dollar in our mission or putting those dollars back into each individual asset. And so what we've said is, how do we set up the financial incentives so that we're incentivized on the back end, to do right by investors and to be aligned with investors, but make the choice to deploy every single dollar into the mission of the business. And that's really what we've done. So we've said, we'll take a piece of the back end so that we're fully aligned, but we're going to choose to spend the majority of our dollars investing back in the company, hiring additional teammates, augmenting the technology to meet our mission, which is to provide more high quality real estate transactions to investors. And that's how we've thought about it. So on the REITs, we have a co-invest. On the individual assets, we're compensated on the back end for that alignment.
So just to quickly explain to folks following at home that might not understand all the lingo, promote is a structure so that once a deal reaches a certain level of profitability, it describes how additional profits are split between different parties. So what Jilliene is essentially saying is that their financial returns are structured so that the better the deal does, there's more incentive for Realty Mogul over the term of that deal. The way a lot of other platforms are structured is it's about volume, right? A lot of these platforms are set up so that a deal could lose money, but the platform could make money because they get a transaction fee just by selling that deal. So I think that's a really important distinction. Deidre, go ahead.
We've got a question. When someone invests 5,000 in the REIT, is it invested in multiple properties or is it invested in one project?
Yeah, so in the REITs, it's invested in multiple projects. The first REIT, which is really focused on income, that REIT has $216 million of property value in the REIT today. So you're diversified across, about a $200 million portfolio. And then the second REIT is more focused on value add and growth. It's limited to multifamily, and the total asset value of that REIT is about $150 million. So the first REIT's 215 million, the second REIT's about 150 million. So, and if you go to our website, we're fully transparent about all of the assets in those REITs. So you can actually see at a granular basis, the address of every single one of those properties. You can pull it up on Google Maps. We have details about what it is, who the tenants are, if it's multifamily, what the rents are. We try and go into pretty granular detail so investors really feel like they're buying specific assets, right? You're not just buying a ticker on a stock exchange, for example, the way that it usually feels when you buy a REIT, but you can really know exactly what you own.
One additional good piece of information I want to share with the REITs, since they're available to accredited investor or non-accredited investors, and this is across the industry, not just for Realty Mogul, but anyone that's offering investments to non-accredited investors is required to file with the SEC. So you can, just like you can if you buy shares of Google, you can go to the SEC and you can look at the documents that are filed, and you file semi-annual and annual report. Is that correct? And
Correct.
additionally,
And then we actually choose to file a quarterly too. So we'll
right.
do a quarterly investor letter that details each individual asset, and we file that publicly. So even if you weren't, an owner of the REIT, you can find those filed publicly, and they're linked on our website as well.
And you also, if there's any sort of material information, you file the 8Ks with that information as well. So the point is, for those of you that are familiar with your 10Qs and 10Ks on the stocks that you buy, there are equivalent documents for Realty Mogul's REITs, and I encourage you to read them, because the biggest thing that's opened my eyes about this industry is so many of your competitors, frankly, they say one thing in their promotional materials, but then when you actually get into what they do, which is what is in their SEC filings, it is stunning. You start to see these related party transactions and the fee structures for some of the things that are built in that they completely disclose, which means they're above board. But because nobody reads those SEC documents, people have no idea what they're investing in. So the key is that can teach you a lot about the management that you can trust and that you can't in this space. And if you're going to invest in any REIT, whether it's publicly traded or one of these private REITs, you have to trust the people that are running it, because they're deciding the properties that you're going to own. So I just wanted to really stress that point. And you guys do great. You really do. I think you do a great job with that.
Yeah, I mean, they're both public companies. So both our REITs are public companies, which means that they're fully audited. And our REITs are also managed by a registered investment advisor. So we're held to kind of an even higher level of standard, being managed by a registered investment advisor. And we appreciate the oversight. I mean, again, it just goes back to culture. Like, another one of our cultural values is details matter, right? Cross your T's and dot your I's. And real estate's a detailed business. There's a great video about the value of $1 in real estate, right? And if you can grow rents by $1, at a 5 cap, it's a meaningful change, right? In the value of the real estate. And so, we have a lot of pride, I think, in the details and in managing the REITs. And again, we're thinking very long term. We're looking for investors that want to invest with us for the long term. And a lot of that is just making sure that we do everything by the book, which is really, really important to the company culturally.
Deidre.
We've got a couple of questions about rates of return and where people can look at returns before they invest.
Yeah, absolutely. So if you are looking at investing in the REITs, you can go to our website and see, very easily kind of the distribution history of both of those REITs. We've been paying distributions on the first REIT since 2016. We have never missed a monthly distribution since 2016. The first distribution was September 2016. So you can find, the statistics about that directly on our website. And then in the second REIT, similar story. We pay quarterly distributions in the second REIT and monthly distributions in the first REIT. So it's a little bit different in how they're structured. But in the second REIT, the first distribution we ever paid was in March of 2018, and we've paid a distribution every quarter since then. I have to say it, past performance is not indicative of future performance. So, no guarantees, but, we work really, really hard to invest in quality assets that we believe in and that we think make sense. So on the REITs, you can find it on our website. And then for the individual assets, if you're an accredited investor, once you get access to the accredited investor platform, you will see a tab called past investments. And we're fully transparent on every single investment we have ever done, what the returns of those investments are. And we have both a debt platform and an equity platform. You can look on every single equity deal. You can look at every single debt transaction. We've had over 150 transactions go full cycle since we started the business 8 years ago. So 150 deals that we originated and that have paid back. A lot of that in the early days was our lending platform. But we've had now over 40 transactions in our equity platform go full cycle, and you can dig into each individual transaction. Where was it located? What was the name of the transaction? How long did we hold it? And what was the actual return? So that's on the past investments tab after you become an accredited investor on the platform.
Go ahead, Deidre.
Oh no, I was just going to say that that's fantastic. I think that being able to view that and dive into the past deals is incredibly valuable.
Yeah, most of the companies out there don't do it for various reasons, right? They have private placement agreements with the sponsors that they can't publicly disclose everything. But I think in general, you have to be willing to show your warts as well as your muscles. if you're not willing to show both, then it's definitely a disservice to people that want to invest with you. Let's see here. Do you see any other good questions here? We got about 2.5 minutes left. Let's see. I think we've one thing I just wanted to ask you about, and maybe you can just make some closing comments here, is, one of the things I think is important, you're a woman in a very male dominated industry, but I was just curious as to your overall thoughts about the importance of diversity in helping build out a better, stronger real estate business. Just curious as to your thoughts on that.
Yeah, look, I think that a diverse team that operates with empathy and respect is going to outperform individuals all day long, right? And, I'm proud of being a woman in the industry. We're proud of building out a diverse team. And I selfishly love diversity because I learn so much. Like one of the things that's so important to me in life is this love of learning. I lived abroad in Spain. I lived abroad in Tokyo. I lived abroad in Beijing. And I learned so much through those experiences of learning different cultures and meeting different types of people. And so, I try and really encourage it across our team. And that being said, as a female in the industry, I have been given the opportunity to work harder more than some of, my male peers. And I'm so grateful for that. There's a funny joke that wasn't so funny at the time, but we've now invested north of $600 million or invested and raised north of $600 million across the Realty Mogul platform and in the Realty Mogul company. And the first $1 million that I raised, I had to do 100 coffee meetings, and I don't drink coffee, right? And I have no idea if it had anything to do with my gender. I mean, I really don't, but if it did, amazing, right? Like mazel tov to me, because I got to hone the pitch and I got to meet 100 really smart people who were telling us, where we should take the business and how we should think about it, and helping to kind of craft the mission that has become Realty Mogul, as of 8 years ago. So I try and just work really hard and enjoy it, right? You got to enjoy what you do every day. And I'm super grateful that I have a job that allows me to do that.
That's great. That's really great. Deidre?
Yeah, fantastic. I think that's a perfect place to end the interview, and just wanted to say thank you so much for coming on. This has been a great discussion.
You got it. Thank you.